Well, if you dig into the numbers, I think the answer is no, at least not yet. We know that a lot of the acceleration at the 3% rate in the last 12 months was due to these one-off factors. Number one, the fiscal stimulus, the ramp up in federal spending, especially in the defense sector, and the tax cut, which had a big boost to personal disposable income, and consumers are spending that. The second is a recovery in oil and gas investment. And once again, that was simply working past the bust that happened after oil fell below $30 a barrel. Those two things are not going to be repeated. The other point that often gets forgotten is that 3% growth required the unemployment rate to drop half a percentage point because we were digging further into finite supplies of labor to deliver that growth. That combination can't continue because eventually the unemployment rate would have to go negative. We need to see some pickup in labor force growth, some pickup in productivity growth for that to be sustainable. As yet, we haven't.
Jimmy P., what do you say?
Yeah, I mean, listen, the thesis that this thing is just not some sort of, short-term Keynesian stimulus. The thesis is that you're going to get more by lowering that corporate tax rate and the expensing provision. You're going to get more business investment, and that will lead to higher productivity growth. Because there is no way we're going to have sustained 3% growth or anything close to it without faster productivity growth. And that is going to take some time for all that to, if it happens, and that last report wasn't too positive.
It hasn't happened yet, really, has it?
It has not happened yet. But the thing is, once it starts happening, it's going to take a while, I think, for that to, that was certainly the case with the Reagan tax cuts, in which we didn't see higher productivity growth for about 15 years to have higher productivity growth. Meanwhile, Fed's raising interest rates, the tariffs are biting in, maybe creating uncertainty, helping depress that business investment. There's some real obstacles there.
Greg, I'm not sure how much you were able to catch Steve's report on how many companies mentioned tariffs negatively on conference calls, but we had a debate last week about economic growth and whether or not we were spending too much mental energy on whether or not the tariffs are an impact. Do you change your mind now that you hear that a fifth of the companies mentioned on conference calls mentioned tariffs negatively? Does that change your mind in terms of, because last week you said effectively that we're spending too much time on tariffs, we the media, compared to how much the impact on the economy actually is?
Well, I am part of the media, so I'm not sparing myself from that criticism, I mean, people want to hear about tariffs. One of the reasons companies are talking about tariffs is that the investor base wants to know about tariffs. But I remember back, 5 or 6 years ago, they would always complain about policy uncertainty. I have some sympathy for when President Trump says these guys are just trying to blame their own mistakes on something else. It's a natural corporate instinct. If you've had a bad quarter, look for anything other than your own actions to explain why it's been bad. Look, when you run the numbers, as folks at Goldman Sachs have, it's hard to actually get really big numbers on growth from these tariff impacts. It's like a pig in a python. There will be a one-off hit to your costs, but it works its way through. Much more important is the overall global economy. We know that China is showing some signs of slowing. Countries like Turkey, Brazil, Argentina, they've all slipped back. The dollar has strengthened. That's a big negative. I would say compared to the tariffs, those are all much bigger headwinds for the U.S. economy. Oh, and if I could add one thing, in spite of all those headwinds,
guys, potentially seeing tariffs put on every single stitch of goods that we bring in from China. I mean, if these reports are correct, they've just crossed and have moved the markets, Jimmy. So I'm not, at this point, can we be so sanguine about the effect of tariffs on the economy? The big unknown is yet to come.
Right. Listen, we don't have a lot historically to go off these kinds of tariffs. These models, they're kind of like those static analysis budget models. What about the dynamic effects? And one of the dynamic effects is, one, the uncertainty, very difficult to model, and two, if they stay in place for a long time, how that really affects the entire efficiency of the economy. So I realize if you do a static analysis, they don't show a huge macro impact. But I think as we're seeing in these sort of company reports, that the sort of dynamic impact of these tariffs could be much bigger.
But, Jimmy, I mean, you would agree that of the two economies between China and the United States, they live off exports far more than we do, right?
Oh, for sure. Absolutely.
So let me... Meaning that it doesn't necessarily impact the US
I mean, what's the point of that? I mean, what's the point?
It doesn't necessarily impact the US that much.
The point isn't that we can punish them more. The point is that we can't punish the Chinese economy. All right. The point isn't that we cannot the Chinese economy. The point is that over the longer term, we have a much less efficient economy, and over the shorter term, if companies don't want to make an investment decision because they're uncertain, that will undercut the Trump tax cuts.
But if I could just associate myself with what Jimmy said, it's over the long run, there's no question that more protectionism reduces productivity. It works completely contrary to the administration's plan to raise the U.S. long-term growth. I don't think on that there's any dispute. I think the question is, are the tariffs that we've seen to date now we can realistically expect a major negative for the economy? And like I said, it's hard to get more than 1 or 2/10 of a percentage point off GDP growth. And by the way, the numbers are a bit bigger, but not dramatically bigger for China. China's biggest problems, like ours, are domestic. But the other point I would make here is that if you actually cut through the clutter, the trade news is actually getting a little bit better. Since the administration came up with a preliminary agreement to renew the NAFTA agreement, we've also seen progress with the European Union. There's even talk that the steel tariffs with respect to Canada and Mexico could come back. I think that the headline risk on tariffs is mostly behind us.
All right, gentlemen. Interesting.
I think that's true for Europe and Mexico. I don't think that's the case for China.
All right.